Aloha from Honolulu. This is Robert Howe. I'm the Chief Executive Officer of Geomatrix Hong Kong Limited. For 30 years since I founded it, a regulated investment advisor in Hong Kong. And I'm also the Managing Director of the AKAMAI initiative, and that includes the AKAMAI Capital, which manages with Geomatrix the AKAMAI Master Fund, and we'll be talking about that. So people often ask me, what's it like to have offices in both Hong Kong and Honolulu? And I quip two island paradises, Hong Kong, New York on steroids, Honolulu, New York on quaaludes, except at Akamai. So Akamai in Native Hawaiian means savvy or financially smart. And that's what we're trying to do is build financial smarts in Honolulu. So we're going to talk about a fund, and we've done really well. But remember, past performance is never a guarantee of future returns. Why invest with us? Who are we? The performance itself, the strategies that have delivered that, and again, the team that runs those strategies. So why invest with us? Look, we've done really well, and I'm going to show you the numbers. And the key is we're uncorrelated with the S&P 500, which is kind of the global benchmark for stock markets. And one reason is we're global. We're not US only. And there's a lot of opportunities we're finding globally. And we're long and short. And this is a classic hedge fund strategy in which you use your analysis of companies to buy companies long and also sell short. So you're using both sides of the analysis of companies. And if there's a market correction, the shorts protect you. And the idea is we don't lose money in bear markets, and we'll make as much or more in bull markets and really over a full cycle. Also, because we don't sell our winners, we're very tax efficient, and this is not always the case with mutual funds or active ETFs. And then you're going to support the Akamai initiative to build homegrown talent in Hawaii. So let's talk about that very quickly. We've been running 20 years, and we're training students to compete with the Princeton eating clubs for the top paying jobs in finance. And it's financially self-sustaining because the fund, the fees from it, pay the instructor and also the graduates as they become interns on the fund. We've changed the trajectory of 60 lives over the last 20 years. It really is a terrific program. And the idea is to create a talent pool locally for the brain drain of people going to the mainland or Nihonbashi or Hong Kong, that they're going to want, when they want to return and raise their families here, there'll actually be trained people that we've trained that can help them open their own business here. And we are launching homegrown asset managers, and we'll talk briefly about that. So we've been around for 30 years. As I said, we're registered. We've been inspected 4 times. We have a terrific office in a restaurant district. It's a small fund. It's what's called a family and friends hedge fund. It's all of our family assets except for the house we live in. And we also seed new strategies, and that's a Hong Kong strategy. We'll talk about it briefly, and an India fund. And then we create a live lab for the students to learn, and that's the graduates of the Akamai Finance Academy. We have a private equity fund that's really isn't part of this story. So what are the strategies? The main one we'll talk about is 70% of this fund is that global equity long short hedge. The India fund is a quality growth fund. The Hong Kong fund is very, very deep value, small cap, the cheapest stocks in the cheapest market in the world. And then we have 5% each in graduates. So why India? Well, if you look at that top line, it's the only market to outperform the US over decades. And the reason is there's a rule of law, thanks to the British. There's both cheap labor and also, if you've worked with overseas Indians, highly educated labor. It's a great combination. We've made a lot of money in Japan over the last few years, and their bear market is over. They're getting return on equity, profitability, religion. Now, China, if you look at the Hang Seng, which is the Hong Kong index at the bottom on this chart, it has been a terrible 5 years for this market, and it is hated. It's called uninvestable, but their technology is incredible. We know that technology drives stock returns. They lead in electric vehicles, in robotics, and increasingly in AI. Europe, we're pivoting there as well because, like Japan, it's getting ROE religion and it's very, very cheap. We're finding opportunities from South America to Saudi Arabia. The US has just dominated markets for the last 7 or 8 years, and there's a lot of good opportunities elsewhere. We have a market pro in each of those markets, India and Hong Kong, and then I'm kind of guiding everything. So this is the performance. It's nearly double the S&P 500 index over the time we've been running this. And let's get into more detail. If you look in 2022, interest rates are going up. It was essentially a bear market, down 19%. We were up. And then as the market roared back in 2023, we were basically flat. We were up a little bit in 2024. But again, in the tariff tantrum, as it was called, in the first quarter of 2025, market at one point was down 19% again, and we were up 15%. So we're going to protect you, and we should be a part of your total portfolio. And if you look at year to date, I mean, we are having a very good year. The index is up 10%. We're up 35. So there's a rule of 72. It'll take you 7 years to double your money, and at the S&P returns, it'll take you only 2 years with the kind of returns that we're delivering. So it's outperformance and low correlation. How do we do this? We go long, we buy stocks to bet on them, the stocks going up if they have rising earnings forecasts, and we do the opposite. We sell short falling forecasts. We consider valuation, but really profit momentum is the key. I mean, a great example is Meta, formerly Facebook. It dominates in social media, very strong earnings momentum. So those brightly colored lines are the consensus of all the Wall Street analysts paid very highly to forecast the earnings at 4 years for Meta. And they're rising. When expectations are improving, the stocks go up. They're also, if you go on Facebook or Instagram, you know that Mark Zuckerberg's ads are getting right at you because he's implementing AI to be the most efficient advertising engine on the planet. And these forecasts are driving the prices ever higher. Also part of the so-called Magnificent Seven of tech giants is Apple, and their iPhone is not that impressive. Their AI implementation has not been that good. And you can see the earnings expectations are falling, and it really doesn't justify their high valuation. So we're short. We're very short Tesla. It's also kind of dropping out of the Magnificent Seven. Sales and margins are going down. Look, for a long time, those earnings forecasts have been falling. Elon Musk has been distracted. The PE is really very high, and we think it's going to go a lot lower, the stock. JP Morgan is an example of a sector we're really, really bullish on, which is financials. And this is a dominator. The higher interest rates give them a good net interest margin on loans. And this is an area where AI is really being applied. Think of banks. It's cubicles of white-collar workers pushing spreadsheets around. And this is something that AI does very efficiently. And they're all acknowledging, and we're seeing this. My son is first-year associate at Bank of America Merrill Lynch. He's the only survivor of the cull. They basically cut 12 out of the 13 first-year associates because the work can be done much faster with AI. So again, rising forecasts are driving the share prices ever higher. Resona is a Japanese bank, a merger of 3 formerly bankrupt banks, and it has a lot of deposits. The cash per share is about equal to the stock price. And again, interest rates are going up in Japan, which really benefits banks and insurance companies. And again, they're going to be slower on the AI savings, but the stock is very, very cheap and moving up. Now let's move to China. I visited this company, Xiaomi. It's a technology dominator. Their showrooms, it's smartphones integrating with your electric vehicle and linked to everything in your home, and they're expanding globally. It's not cheap, but you can see those earnings revisions are really, expectations are rising. And then also in China is a brokerage firm, and as investors or households shift from buying yet another apartment that hasn't worked out that well, they're starting to buy stocks, both in China and in Hong Kong and elsewhere. And this company is the leading online broker there. And you can see prices are going up. Rheinmetall is one of our best European stocks, and it's a defense contractor. It supplies turrets and projectiles for nearly all of NATO. and it has a reliable drone defense. They paint the sky with little projectiles, and that's a lot more efficient than firing a $1 million missile to take down one of 43 drones coming at you. The stock's expensive, but again, we're going to hold on to it until the earnings begin to turn down. So just how are we positioned? We'll go very quickly through this. The main thing is we're 257% gross invested, 186% long, 71% short. So your money's working harder than you would in an index fund or an ETF or a mutual fund. And we're slightly bullish, but mostly in non-US markets. And if we look at that country exposure, we are actually slightly net short in the US, mostly index futures to protect against a market correction. Very bullish on Japan, again, long Arizona, they're having to take responsibility for their own defense. China, it's really about technology, and Germany's a little bit like Japan. The financials are doing extremely well, and they're responsible now for their own defense. Just quickly on sector exposure, it's financials, it's the application of AI and positive yield curves. If you've been to Japan as a tourist, the yen is very, very weak. And as interest rates start to go up in Japan at last, the yen's going to appreciate. We can cover our corporate structure if we have a further conversation. I'm going to also go quickly through this. I've been around for a long time. I bought my first stock when I was age 16, and after 2 Ivy League universities, I went to work in the markets. And the markets are humbling, but I've won a lot of awards over many decades of serving my clients. Mortis has been with me for 30 years. He joined in our New Jersey office as kind of a quant, and then has really evolved first into our primary technology and automotive analyst. And he's now more than an equal partner in running the fund. So I've really delegated more and more to him. He's an Indian, so he's part of the overseas Indian intelligentsia. And then the sub fund for Hong Kong is run by Hal Thomas, and that's deep value. And then we do have kind of special opportunities funds that we're launching for them. And again, we've got 2 of our graduates running 2 different strategies, and they're doing actually quite well. I should put a line chart for them. Ambar has outperformed the Indian market over long time periods. It's a tough market to beat, and he's got a partner. Besides our office in Hong Kong, he has 2 offices in India. So he's actually, he's out there visiting companies. Hal is outperformed the small cap index, the orange line, but he's lagging a little bit in the recovery of the Hong Kong market. Hong Kong is bottomed, and this is a great market to have exposure to. It's the cheapest it's ever been. And the companies, other than the property companies and maybe Chinese banks, there's a lot of very interesting things. Again, he's been around for a very long time, and I've been really pleased working with him. So to summarize, you really want to diversify globally. The U.S. has dominated world markets. If you have a lot of money in the U.S., don't necessarily get bearish, but start to invest with us in global markets that are cheaper and the companies are growing faster. And you really want veterans who know what they're doing. These are sometimes unfamiliar markets to you, but not to us. We've been here a long time. And, visit us if you like. Hong Kong, which is, New York on dumplings, and Honolulu, which is New York on Mai Tais. So come and share each of those with us. We'd love to help you with your investments.